Hello and welcome to our Financial Literacy Education series, where we help you have a better understanding about your money, become more engaged with your money and make smarter decisions about your money. My name's Corin Jacker. I'm from Priority One Wealth Management Group. During this series, we've covered a range of topics, starting by why we even need to understand our money, getting good advice, looking at all sorts of wealth creation options, starting at cash flow and budgeting. In today's episode, we're going to start looking at retirement issues. So there's lots of things we need to consider in retirement. Financially, we need to look at income options. We need to look at what we're doing in relation to our assets and how we manage the risks in relation to that. We might need to look at social security issues, possibly aged care issues, and then there'll be things that we cover off in other topics such as insurance and estate planning. Retirement is such a large portion of our lives now, so we really need to consider what we need to be thinking about when we're approaching and going into retirement. We're going to cover off a few of the financial issues in today's episode, but we want to really make sure we have a good think about some of the non-financial issues. So what are we wanting to do in retirement? So we need to set some goals and objectives. So some common things people would look at is, do we want to travel more? Is there hobbies we want to take up or continue more? Do we want to volunteer? It's important in retirement to maintain social connections, for mental health and well-being, for physical well-being. So it's really important to understand what you're going to be doing with your days in retirement. It can be a big shift for some people working 9 to 5, 5 days a week or 6 days a week or 7 days a week for many decades of their life. So to switch to retirement and not have that as part of our daily lives, it needs to be filled up with something meaningful that's important to you. So it's important to have a bit of a think about what's important to you for life after work. What do you want to be doing? What's going to take up your time? Then you can start looking at the financial implications of those decisions. The main things that retirees need to consider usually stem around three main issues. The first one, having enough money come in to do what you want to do on a day-to-day basis. Second thing is having access to money should we need it. And the third thing is we would like our money to last a bit longer than we do. Some other issues that retirees at the moment see as pressing concerns, issues relating to aged care, health care, medical costs and how that's going to be funded. We did talk in a previous episode about how things that seem luxury items today soon become necessities as part of society. And things like healthcare is one of those issues, where technology is providing much greater access to things that keep us alive a lot longer and healthier. But these things are going to cost money. So we need to consider that in not only retirement planning for today, but also what we might need to consider in 10, 20, 30 years' time. We need to consider the risks we face in retirement. So we talk about risks in other episodes in relation to asset management. So things like market risk, we've got regulatory risk, so the government can change the rules on us, particularly in relation to things like superannuation and Centrelink. We've got our own behavioural risk, which we'll cover off in another episode, in terms of our behavioural biases which might affect our decisions in relation to money. Two main risks that retirees need to consider though in retirement, and they conflict each other. The first one we hear a lot about is longevity risk. So will we outlive our money or will our money outlive us? So the main way to reduce longevity risk is to expose your assets to higher growth, higher returns. However, the other risk that we need to consider though is what we call sequential risk, which is if something goes wrong at the wrong time, it impacts you greater. So let's take the global financial crisis as an example. If you were 25 when the GFC hit, you probably didn't get affected too much because you didn't have much in the way of assets typically at that age. If you were 95 when the GFC hit, again, it probably wouldn't impact you too much because your needs are different at that time. But if you were 55, 60, 65, you're just approaching retirement, or you've just retired and you've got your money in 100% shares, for example, because that's what you've done for the last 20 or 30 years prior to that, the markets fell potentially 50 to 60%. That has a massive impact on your retirement planning from then on. So to reduce sequential risk, we take a lower risk approach to our investments. What happens though is because we're taking a lower risk approach, so we're reducing that sequential risk, then obviously we're probably going to get a lower return, and that could potentially increase our longevity risk. So we've got to get a balance between having enough growth assets to hedge out inflation and to make sure our assets last long enough, but not taking excessive risk where if something does go wrong, it impacts us too much. So we're going to look at retirement income options. So the first one is Centrelink for a lot of people. So broadly speaking, if you're a couple, you own your own home, currently around $900,000 worth of assets outside your home or less, and you'll get a part pension. So that can be a good foundation of income for most people in retirement. Once you get to age pension age, which for most of us will be 67 years of age. For some, their superannuation structures will have a defined benefit pension. So that's usually an indexed lifetime pension that's provided from the provider, and there's no asset behind it. You just get a guaranteed indexed income for life. For most of us though, our superannuation is not structured that way. It's structured where it's an accumulation fund, and what the fund does will relate to what's invested, and how much income we take and how long it lasts will depend on that. So the first income stream that most people would look at when they're taking their superannuation is an account-based pension. So an account-based pension is where you take your accumulation fund and you're literally converting it to an income, so money starts coming out rather than putting money in while you're working. It'll earn money depending on where it's invested. So that'll be a decision you need to make in relation to what risk we want to take. And then you can take out, as long as there's a minimum payment being met, any amount above that. So it's flexible in relation to how much income you can take. The other structure though that should be considered is what's called an annuity structure. So with an annuity, what you're typically doing is you're taking some of your money, providing that to a provider, and they will then give you a income in return. You may have access to that capital, but it's very limited. So typically the expectation is you're not seeing that money again, and the income can be paid out for a term, often a long term, 15 or 20 years, or even lifetime. The reason why we might consider annuities is the first thing that we look at with annuities, depending on how they're structured, they can have a Centrelink benefit. They can have an exemption for part of the amount you put into it for asset tests and income tests for Centrelink. So that can improve your age pension eligibility. They also provide rates that are typically in line with long-term interest rates. So as interest rates rise, these provide a reasonably good income stream that can replace other forms of defensive investment exposure like term deposits. So for money outside superannuation, where you're looking at those account-based pensions or annuities typically, people might then look at where else they can put their money. And you can start by putting it in cash. Often people will put it in term deposits, but then you can also put it into things like shares and property as well. The main issue with having money outside the superannuation structure is largely around tax. So for most people, superannuation is a tax-free world in retirement. The money that you have invested in your own name will remain taxable to you. Now, depending on how much you have invested in your own name, you still may not pay tax, but it's a consideration you need to look at. So social security entitlements, which we've already touched on briefly. So the main one is around age pension. For some people, depending on your age, if you're not age pension age, there could be disability support pension entitlements. There could even be job seeker entitlements as well, depending again on your situation. The other thing we look for Centrelink for is in relation to the concession cards that may be available. So if you're on the age pension, you'll get the pension concession card, which typically gives you most of the benefits available. But a couple of other cards are available. So the first one, once you're age pension age, if you're not eligible for age pension, you're probably going to be eligible for the Commonwealth Seniors Healthcare Card. That's not an asset tested position, that's an income tested, and it's an adjusted taxable income. And for most people, your adjusted taxable income in retirement would be below those thresholds. The other one though to look at, regardless of your age, is the low income healthcare card. Again, it's not asset tested, it's a short-term income test, so they look at your last 8 weeks of what you've earned. They'll take what they call a deeming rate approach to most of your assets you've got, and currently, at the time of this presentation, deeming rates were relatively low, which means you could have actually a rather large amount of assets and income and still qualify for the low income healthcare card. It's worth looking into because the low income healthcare card gives you more benefits than the Commonwealth Seniors Healthcare Card. Not quite as much as the pension concession card, but it's still a good option. Also with Centrelink, there's an opportunity to continue working in retirement, and for some people have that money, or the first part of that money is exempt for the age pension and other benefits. So it's just a way of keeping part-time work in place without getting penalised by having a reduction in your age pension. So it's worth looking into if you wanted to continue working part-time. For Centrelink entitlements, for most people, it's the age pension, but if you're part of the Department of Veteran Affairs, then certainly speak to them and there'll be benefits available to you if you're eligible in that space. So in summary, the main issues we need to look at for retirement planning. First of all, what are you going to do with your time? Life after work. What are you going to travel? Are you going to be members of groups in the community? Are you going to take up a hobby? It's important to make sure you fulfill your day with meaningful activities for your mental and physical well-being. The second thing is to look at is your financial structure. How much income are you going to need to meet all these needs? Where are you going to invest that money? And how long is it all going to last? And that's certainly an area where a financial advisor can certainly assist if you're not sure of those areas. Keep an eye out for our other episodes in our series. After retirement planning, we're going to look at aged care in more detail. We're also going to look, as part of our series, at issues in relation to particular age brackets. So we'll again cover off issues in relation to people leading into and through retirement. Also important to consider the series where we look at insurance and estate planning as well. Thank you and goodbye.